is that 8.7% yield representative of what we can expect for the near term?
So a lot less volatility and risk to the downside in your portfolio than maybe a covered call product.
How will this fund react to changes in interest rates in terms of the price and the income? Garrett, we've covered several covered call index funds that yield in excess of 10%. Why would an investor be interested in this new HYBI fund that yields 8.7%?
Sure. So investors would really look at this for lower volatility and less correlation to where this would be an allocation into their fixed income side of their portfolio. And for example, if you think about 2022, the S&P 500 was down roughly 18%. The Bloomberg High Yield Index was down a little over 11%. And this fund during this period of time, which was the WSTCM mutual fund, was actually down 2.3%. So a lot less volatility and risk to the downside in your portfolio than maybe a covered call product.
Okay, that makes sense. And if you're watching and you're unfamiliar with Garrett, we did our first interview in September of 2023. That one was about SPYI. I guess you would call that your flagship fund. Would that be right?
Yeah, that's correct.
Well, that fund is based on the S&P 500 and it yields around 11 or 12%. And back then when we recorded that interview, the assets under management was about 300 million. So what's it at now?
So now it's up to a little over 2.1 billion.
Wow. So that's an impressive amount of growth. Okay, let's get back to HYBI then. So for that 8.7% yield, the number that I gave before, I came up with a number by taking the first distribution, which just came out, multiplying it by 12 and dividing by the price that I noted at October 25th. So my question is that 8.7% yield representative of what we can expect for the near term?
It is. We pass through both the fixed income underlying payments to investors, and then we're also adding a option overlay that's seeking to add an additional 2 to 2.5% of tax efficient income on an annualized basis.
Even though 8.7, I said at the beginning, is less than your other funds like SPYI, it's still a high number for a bond fund. So let's get into the reasons why it's high and the risks that are associated with that. First of all, I wanted to explain, or for you to explain, some of the basics of the fund. So we're talking about bonds, and there are quite a few of them, but you don't buy them individually. So how do you hold the bonds?
That's correct. We actually use ETFs as the way to get exposure to the bonds. And there's several reasons we do that. One, we think about liquidity, right? There's less liquidity in the fixed income market overall than you see in the equity market. But we're buying these bonds to give us exposure to, high yield corporate positions. And these ETFs within each one could have anywhere from 1,000, 2,000, 3,000 bonds.
Okay, well, that makes sense to spread it out like that. And just to be clear, we're talking about high yield corporate bonds. So these are instruments that companies use. Instead of borrowing money from a bank, they can effectively borrow it from investors. So for a high yield corporate bond, we could be talking about, say, a 5-year bond that yields somewhere in the order of 5 or 6%. And I noticed when I was looking at the holdings, the largest one currently, as we record this towards the end of October, is USHY. Do you call that USHY or USHY?
That's a good question. We try to pronounce it the whole USHY, but it could be USHY or ASHI.
USHY's easy to remember. Okay. So that one currently accounts for almost half the portfolio, so I guess it's relatively important. That one's yielding about 6.5%, and it holds almost 2,000 high-yield corporate bonds. Now, today we're not going to go into a breakdown of all the inner workings of each of the funds within your holdings, but I looked that one up, and there's an excellent analysis on Seeking Alpha by an author named Juan de la Hoz, who's one of my favorites. So if anyone does want to do a deep dive into that fund, I'll put a link in the description to his analysis of the fund and other competing funds in that high-yield corporate space. So I was going to ask you how you choose these funds that make up the holdings for HYBI. It's not necessarily that you choose them, it's that they were already chosen for you by this fund that you mentioned before. So can you explain a little more about that fund and how they chose the funds that are inside the holdings?
Sure. So we've known the team at WST for a long time. They focus really on managing money for ultra high net worth and family offices. And we've been really impressed with their credit select model and how it's been able to manage risk in those really troublesome times for equities or fixed income. And our thesis has always been, again, quantitative strategies. And so this is a quantitative model. It's rules-based, and so it's not an individual portfolio manager selecting the ultimate positions and when we de-risk. And so we had the opportunity to buy the mutual fund and convert it to an ETF.
So they had a strategy. As you mentioned, it's rules-based. So it's not just a fund manager managing it by the seat of his pants or her pants. But could you give us some sense of how the strategy worked when it was a mutual fund?
So the model in itself really kind of has three core factors. We look at price trend within the underlying high yield space and the potential funds we could own. We look at credit spreads, so how tight and wide are credit spreads, thinking as an example, high yield relative to treasuries. And then also we overlay relative strength. So a great symbol of really the pressure of how a fund is performing relative to its underlying benchmark. And so those three factors are the core inputs into the model to be either long high yield or to be able to reduce risk along the way and protect investor principal.
All right, so you're watching those three factors, and then they give you an indication of when to make changes to the portfolio. We've referenced this mutual fund that you've acquired. If people want to look back and see, well, what was the performance of that mutual fund, it's not as easily available as an ETF, which you can just type into any website. So how could we get a sense of the past performance for WSTCM?
Sure, the best place is actually go to the NEOS websites, neosfunds.com, and that actually has the historical performance of the mutual fund embedded in all of our performance returns on that page.
Okay. Now, you mentioned three metrics that help you decide, based on this rules-based model, of when to increase or decrease, the risk. So let's say you need to reduce the risk. It's telling you that that's the next step. What would you actually do to the fund to reduce the risk?
One would be from going from a high-yield corporate bond exposure via these ETFs into more of a core and investment grade. So something to be almost in an ETF like an AGG or BND where you're long core and just more high credit worthiness companies within that ETF. Another is to utilize treasuries and to reduce the risk of the credit and duration as a whole by allocating to cash. The fund currently has that cash position where we're long, somewhere 1 to 3 month treasuries as a portion of that allocation at the moment.
Now, it's funny you should mention that, because when I started looking at HYBI to prepare for this interview, there were 3 high-yield corporate bond funds in your holdings on the website, and that's updated quite regularly. And then today, as I look at it, it's changed, and the treasuries you just mentioned have entered the picture. So that means you've recently made adjustments to reduce the risk.
That's correct. Late last week, our spread indicator showed us that with spreads being so incredibly tight that we should reduce some of our risk and allocate towards treasuries. So we did that late last week. And so you're seeing the treasury allocation in addition to the 2 high yield corporate ETFs that we own that we spoke about before.
So now we have an understanding of WSTCM and how that works. And we're going to get into the differences between that and the new fund, HYBI. But before we do that, could you give us some sense of competitors, maybe other funds that potential investors could compare HYBI to, another perhaps corporate bond fund that uses options to generate income?
If you're looking for just a core high yield, without the option overlay piece, those exist out there. But when you really compare the two, we have yet to come across anything that's doing what we're looking to do through risk management and the yield enhancement.
Okay, so this is something new. I'm guessing if this one were to grow to 2 billion, all of a sudden there would be other new funds that use this strategy.
I'm
Is that
sure
pretty
you're
much how it works? Okay. But that's when you know you're doing a great job, right?
I guess so, yes. We'll take the imitation as a sense of flattery.
All right. So before we get into the nitty-gritty of the strategy, what are your general expectations going forward for this fund? I know you can't promise anything, you can't predict anything, but how will this fund react to changes in interest rates in terms of the price and the income?
Just generally speaking, this product, along with any other fixed income instrument, if you're having rates come down and so yields are going to be lower, the income that can be paid off of a bond would be lower, but the price of the bond would be higher. And so you'll see price appreciation if rates or yields are falling. And then same thing with the inverse. If you saw rates increase, you're going to see the price of a bond decrease. Very similar to what you saw in 2022 as the Fed was starting to aggressively hike interest rates. You saw bond prices fall quite substantially in that type of a period. In addition, when you see the options income portion, that's all attributed to volatility. And I know we'll talk about that later, but you would see the opportunity that in higher volatility times, more income from the options. In much lower volatility times, a little bit less coming from that component of the fund.
And would you say that it's reasonable to expect that the income won't change dramatically over a short period of time?
I would say so, because if we go back to how long the duration is of the bonds in our underlying holdings, those are averaging over 4 years currently. And so you're not going to see, on a week by week or certainly probably month by month basis, a drastic change within the underlying core part of the fund, which is that fixed income.
That's useful to know for investors that are focused on income, which is most of the people watching, I think. So let's get into the strategy then, the options part of it, because that's the special sauce that NEOS adds to this. This option strategy that you're adding is what creates the difference between the 5 or 6% that typical high-yield corporate bond funds generate and the 8.7 that I mentioned at the beginning of the interview. Previously, when we talked about SPYI, we looked at covered call strategies, but this fund is a little bit different. You're doing put spreads. So can you explain how that works, starting with how far out of the money you write the options?
So we're writing those put spreads on average of 5 to 8% out of the money, and we ladder them. So I know we've talked about covered calls and laddering those so you have different strikes. We do the same thing on the put side, is we want to make sure that if we're selling maybe a 5% out of the money put, which helps us generate money, so that's that initial credit, we take a portion of that to buy maybe, let's say, an 8% out of the money put. And so your spread risk overall is roughly the difference between the 5 and the 8%. But we like to stay out of the money, and we also like to stay very short in duration. And so on these options, we're looking at roughly a 2-week duration, but that gets to be rebalanced every single week. So this allows the overall options portfolio to look to match the same standard deviation or risk that the fixed income is. So it's not meant to add a lot of volatility in the fund. It's actually meant to meet the same volatility profile of high yield, but be able to generate that additional, 2 to 2.5% over a period of time.
You said 5% as an example, and we won't hold you to it being precise, but that's a little bit further out of the money than the covered call index funds. Is that right?
That's correct. Yes. Our covered call index funds range on average between 1 to 4 or 1.5 to kind of 5%. On this side, in fixed income, we always are managing to risk first. And so this fund is in particular is looking at 5 to 8%, but some of our other products even go 10 to 12% out of the money because we're really looking to match, again, that option portfolio to the risk of what the underlying core investment is, in this case, high yield.
Okay, so you mentioned risk. The further out of the money you write these options, the more conservative or less risk there is. You generate less income, but there's also a lower probability that the option will be exercised.
That's correct.
And what percentage of the portfolio do you intend or are you currently writing options on?
So on these types of portfolios on the fixed income side, we're looking to overlay on 100%. because we're being conservative in the out of the moneyness and the fact that we're constantly rebalancing the portfolio each week, that's the ability for us to be able to write on 100% to generate the income in addition to what the fixed income positions are going to be yielding.
And in the example that we talked about before, which I think is in the general ballpark of how this will work, you're selling an option and it's 5% out of the money. You buy one that's 8%. So the difference is 3%, and then you collect some income. So there's this additional income generated by the strategy of, let's call it 2.5%. Investors are going to love that if they're focused on income, but there's no free lunch. So what are investors either giving up or risking to get this extra, call it 2.5%?
When you put on a put spread like this in a portfolio, it's essentially adding in a very small amount of equity risk. The potential risk or the risk return payoff to this is going to be maybe a very sharp sell-off in a more like catastrophic market environment where, let's use COVID as probably the most recent example, where you have the S&P down 30 or 40% over only a couple week period. And so that is going to have a detraction of positive return from the overall fund because you're adding in that slight equity market bias into the portfolio.
So you mentioned the pandemic. In a major crash like that, could you quantify in percentage terms just an approximation of the risk added by this option strategy?
If you woke up tomorrow and you had a portfolio of put spreads that had that 3 or 4% spread risk, right, between the one you sold and the one you bought, and the market went to zero, that would be your max loss, that 3 to 4% minus whatever premium you brought in, whatever income those options generated for you. So you always want to quantify your risk in essentially these types of strategies. And so that's why we always do everything on spread. But the investor's risk is always going to be the difference between the put that they sold and then the one that they bought. And in the case in the examples we've been using today is, 3 to 4% would be your max loss if the market went all the way down to, let's just say, zero.
And just to clarify, we're talking about the options part of the strategy. What the high yield corporate bond part of the fund does is a separate matter, right?
Yes, that's correct.
Okay, now in contrast to the other covered call index funds where, say, it's SPYI, it's based on the S&P 500, the holdings are based on the S&P 500, so are the options. Here it's a different scenario. You've got a bond fund, but the options are based on equities, again, the S&P 500. So why did you pair those two different instruments together?
Actually, for what investors might not know is these strategies where you pair an equity option with an underlying fixed income have actually been time-tested strategies that major institutions have done for decades. So pensions, endowments, they look to use their fixed income as a way to be collateral to generate more income with option writing. And so we like this for one of the reasons is the inverse correlation that you generally receive from fixed income relative to equities. And so if equities are doing well and fixed income isn't doing as well, that's a means to add additional returns to this potential fund. We also really like the tax efficiency. So we've spoken a lot in other interviews and other discussions around how those index options get a preferential tax treatment by the IRS, calling them a 1256 option. And for today, the short answer to that is, regardless of our holding period, that option's income gets taxed at a 60% long-term capital gains rate and a 40% short-term. The last benefit we look at is just the liquidity. There's significant liquidity in the S&P 500, and you're not always getting that same liquidity in fixed income derivatives.
You mentioned tax, and I think that's a pretty important element for all of your funds. The one that we talked about first, SPYI, has significant tax benefits. It's very tax efficient. Will HYBI offer the same tax efficiency as SPYI?
So it'll be slightly different, and I'll explain why. Is for the fixed income piece, we do pass on those fixed income coupon payments, right? Those bond payments. And so those get taxed generally in all fixed income as ordinary income. And so that's something that is out of our control. On the other side, for the options piece, we do have that same tax efficiency by using that S&P 500 index option, so that 1256 that I had just referenced. The other difference is, although our products all have a tax loss harvesting element to the strategy, where when a fund might have a loss, we try to capture that in the way that that could benefit investors in the future by offsetting a taxable gain with a old historical loss. In this fund, it's a little bit more challenging because you're long the fixed income and you have this slight net long equity bias from the options. In a covered call, you're long the equities, but you're short the options. And so that gives kind of a more long-short portfolio. So for this, we won't have what we've talked about in the past is a large percentage of return of capital, meaning you're able to reclassify long-term, short-term, and ordinary income into what is defined as a deferred long-term capital gains treatment.
Okay. Are you able to give us a sense of how much? Because the return of capital is probably the single greatest contributor to the tax efficiency of QQQI, SPYI. For those funds, the return of capital is more than half of the distributions, right?
That's correct. Those covered calls, if we look back at maybe, say, 2023 in some of our products, have been north of 60%, 60, 62, okay. 65%. On these, if I look back at even some of our other fixed income products that have the same underlying structure, just not high yield, maybe core fixed income or just treasuries, those more range in that kind of 5 to 10% return to capital. So it's definitely less than what you're going to get in a covered call.
Okay, then it sounds like this fund, HYBI, will be less tax efficient than, say, SPYI, but more tax efficient than your typical bond fund.
That's correct. It's really looking at the ways we can add that additional, say 2 to 2.5%.
Okay. So we've talked about a lot of components. I think this is the most complicated ETF we've ever discussed, right?
I think so, yes. There's the underlying component of the fixed income and how that model works, and then, of course, how the option model works. So, it definitely takes time to kind of walk through both models since one's just not an index-based product.
All right. Well, I'm trying to boil it down. So this is how I'm thinking about it. You've got QQQI from NEOS that's high volatility because it's based on the NASDAQ 100 with all the tech growth stocks, and it pays a whopping yield of in the order of 14%. Then you've got at the other extreme a fund like CSHI that's paying a yield of 5.5%-ish and very, very low volatility. And we haven't discussed that one on this channel because we focus here on higher yields. Those are two extremes. Would it be accurate to say that HYBI is pretty much in the middle between those two extremes?
It is. I would say I think that's a great representation. When you think about just equity volatility, and you're looking at that ranging kind of 15 to 20%. You're looking at high yield volatility is roughly, call it 8, maybe 8.5%. And then you had referenced CSHI, which really treasuries with almost zero volatility. But if you compare that to short duration fixed income, that's the standard deviation of volatility of around 1.5. And so you're seeing that HYBI, actually, because of the risk management, is going to give you that high yield exposure, but is going to have a standard deviation of volatility that is in between that CSHI and that QQQI.
All right. I think that puts a nice bow on it. So let's wrap up by looking towards the future. Can you give us any hints or insights into what you've got coming up in your pipeline, either right now or in the near future?
Just about a week and a half ago, we launched our Bitcoin High Income ETF, which is the ticker BTCI. So it's giving you exposure to Bitcoin with that high monthly income. We also filed for 2 more products that we're excited for that should come out hopefully around the end of November, which is going to be our 20-year plus treasury bond portfolio with this enhanced income, something similar to what we talked about today, but exposure to 20 plus year bonds, as opposed to maybe our CSHI product that's 1 to 3 months. And then we also have a real estate high income ETF that's going to come out. So where you get exposure to the broader US real estate market, but being able to do those laddered covered calls to generate a much more higher degree of income. So again, just expanding the optionality, pun intended, for our investors and clientele to be able to choose what products they fit in their portfolio relative to their risk and income goals.
All right, that's a lot of ETFs. Do you guys ever take vacations?
Not usually. We love this space. As everyone knows, we're very passionate about it. But we also have a great team here. We've grown to over 20 people now. So a lot of people here dedicated for our investors on a day-to-day basis.
All right, Garrett. Well, I appreciate you explaining this new ETF, and thanks for your time.
Thanks for having me today. Appreciate it.
All right, that wraps it up for this look at HYBI. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.